Good morning. It is Friday, November 30th, the second month of what I thought would be a 1 month correction. So, question I posed to the gallery a couple days ago was, will President Trump trade America into a recession? And I was going to write an article about Chairman Powell needing to become a little bit more dovish, and he did that. Um, and I was going to write an article titled Fed Powell Didn't Blink, He Woke Up. But I haven't done that yet either, but I think I will get around to that one. And I thought of another title of an article that Powell gave the market hope, and he gave President Trump rope. And I think that that's probably very true. I think that the Fed deciding, and I think the membership had a lot to do with this, because I think President or Chair Powell is inclined to keep raising interest rates, but the other members of the Fed have essentially convinced him that the neutral rate for interest rates is right in front of us. And I think that's good, because I think that the neutral interest rate is here already. They'll raise interest rates up another quarter point in December, but I would anticipate between 0 and 2 interest rate hikes in 2019, depending on what happens with trade. So let's get to that. Tomorrow, President Trump and President Xi meet. And the talk is that they are going to declare a ceasefire. And Goldman Sachs doesn't quite see it that way, but they do almost make it a coin flip between a ceasefire with continued talks or an escalation of the trade war. And moderates in both governments are looking for this outcome, which would be kind of a détente, and basically buying time to negotiate a better trade deal between the two countries over the next several months without raising tariffs anymore. I lean in that direction, but I'm not convinced. And Goldman Sachs leans in the direction of an escalation of the trade war. So let's talk about what happens if there is an escalation of the trade war, because we've already really talked about the potential for positive surprises that I talked about way back in February, that there was likely to be positive surprises in trade. But given the rhetoric, given the track record now, short term as it may be, and the jitteriness of the markets, even a pretty well, even a guy like me who tries to convince himself that he can control his emotions and tries to look at things strictly as analysis, I don't know what to think. I don't know if President Trump and President Xi, who are both hard-headed guys, very prideful, and very convinced of their own being right, I don't know which way this is going to go. So there is a trade that we're going to make, or that I've been making this morning, that I already emailed out to members, that I think might make some sense. In any case, let's talk just a little bit about what the outcomes could be here. If there's an escalation of the trade war, and there's a million charts out there that you can see this with, then that will mean that global trade decreases. We know that global GDP goes up with the amount of global trade, and that has been a relationship that has held for decades. So if the number 1 and 2 economies on the planet are slapping 10 to 25% tariffs on each other and looking for ways to move supply chains and trying to one-up each other, then an escalation can get very dangerous. This concept that some people have, and frankly, I'll call it an ignorant concept, that a trade war with China is winnable, kind of blows me away, to be honest with you, because China doesn't have just one tool to wield here. So let's take a look at this scenario. Let's suppose there is an escalation of this trade war. And the Chinese look at President Trump and go, we got 2 more years of this guy. We have to take care of ourselves. China has been trying to become a more consumer-led economy. This would be an opportunity for them to do that. And how would they do that? Well, at that point, they wouldn't want a weaker yuan. They would want a stronger yuan. They would want their currency to get stronger. How could they do that? It would be fairly simple. All they have to do is cut deals with Saudi Arabia and Iran to buy some oil and natural gas in yuan. So already a little bit of that going on with Iran. But if they cut a deal with Saudi Arabia, that would be it. The petrodollar would be irrevocably damaged, and the value of the dollar would plunge anywhere from 10 to 20% fairly quickly, while the value of the renminbi, yuan, rose 10 to 20% relatively quickly. That would give Chinese people more buying power, the type of buying power that we enjoyed over the last 20, 30 years, 40 years, 50 years, right? So if the petrodollar is damaged, and you can bet that if China decides to go full out retaliatory, that's going to be something they go after. They've already put into place the oil futures market over there. It's backed with gold. They want to diversify. Saudi Arabia wants to diversify their currencies and their economy. China can work with them on everything that they need to be worked with. So the unintended consequences of pushing harder on China is that they suck it up. And they say, you know what? Fine. We'll cut our trade with you, maybe permanently, and we'll turn to the rest of the world. And if they do that, and they attack the petrodollar, and they start dumping U.S. bonds, there's all sorts of different ways that they can manipulate currencies and create permanent damage. So the idea that this is just a one-way street, that, we're punishing them and they're paying us, don't count on it. What if President Trump slaps the 10 or 25% tariff on iPhones? Sure, Apple will start building iPhones in the United States, however many millions they need here. They need what, 45 million a year? I don't even know if that's the right number. It might be 45 million every 2 years. However many iPhones they need here. And I've actually contacted Governor Evers in Wisconsin. I sent him a tweet and an email. I said, hey, maybe you should call Cook over there at Apple and say, we got this Foxconn plant in Wisconsin that's going up right now, and Corning isn't too far away either. So maybe you'd like to put an Apple plant between Chicago and Milwaukee in a farm field in between, right along Highway 94, which, by the way, there's a train corridor if you really want to train. So now that Scott Walker's gone, we can put our trains in. I don't think that is a far-fetched idea, but what does that do for all the other iPhones, right? They keep getting made out of China. They get sold to the rest of the world. It's not going to be hard for the Chinese to fight back. They have a quarter of the global economy, just like we have roughly a quarter of the global economy. So if that happens and there's an escalation tomorrow or over the weekend, I think that we should get ready for some very rocky times. And I think that we need to have a hedge in place because the market reaction could be violent. And, we are at the edge of breaking through some support levels that I'm very concerned about. So let me show you these support levels. I think I have them in the other article as well. So let's just do the other article. SPY puts as a hedge. Pretty straightforward, right? We took profits on Tesla. At least I did, and I suggested everybody else does as well. I took profits on Tesla, so I have cash up from 4% to about 8% of accounts now. And I am concerned about this chart. So I use exponential moving averages more than I use simple moving averages because the exponential moving averages amplify the more recent moves, which I think are more important. In my weekly charts, which are basically the long-term trends, I look at the 1, 2, and 5 years. Okay, and the reason I look at 1, 2, and 5 is because historically 2-year charts, you'll see some people out there that use 100-week charts. I use 104 just because don't want my OCD to trigger. Oh my God, there's 52 weeks in a year. And this is usually where you find the best information. This is where the biggest supports are because any 1 year is not so important, but 2 years, that's a pretty significant trend. 5 years, that's usually the better part of a cycle, and you really can go back further than 5 years if you can identify the start of a new cycle. And in fact, the new cycle really did start way back in 2009. So I could use a 10-year chart here. But stick with 5 because there was pretty significant movements in 2011, 12, and then again in 15, 16. I think the 5-year is relevant. This black line, though, is equivalent to the double top. This is right for this is the financial crisis top. Then it's similar for the tech wreck. So this line is if we really have a crisis. I've talked about how we could see an S&P 500 level of around 1,600 again if there's a crisis. I don't see a crisis out there. I think that the debt concerns are overblown, which I mentioned today again on Twitter, and I'll eventually write about that. But, the debt problems have to be dealt with, but they're not end of the world stuff, mainly because the world economy can handle 2008 debts with the size of today's economy and the amount of money that's out there. Now, if debt levels doubled again, we'd have problems. In any case, we are just above 259, which is the 2-year exponential moving average. I consider this to be a pretty significant support indicator, and if you put in all the other wiggly lines, you'll find that they all kind of converge to this area, right? If we break through this 259, and the way that I understand technical analysis, which is not the way that Avi Gilbert or anybody else will understand it, but it's worked for me in the past, and it comes from pretty smart people. Didn't make this stuff up. We could see the S&P 500 drop all the way down to the 230-ish, 230 somewhere. With it, because the next super strong support's at about 227 on the SPY. So that's a pretty large drop, right? Over 10%. And I'm concerned about that. So if we don't get a trade deal, if there's an escalation, I basically expect this to happen. Money flows are not being supportive right now. We need to see the money flows turn up. So hopefully this trend continues. Hopefully there's a detente, there's some sort of agreement to keep working on things and put off more tariffs, and this choppy line chops up. Because as we know, as money flow into the market rises, stock market generally rises. And again, you can just go look at these. Leads a correction. Leads a correction. Leads a correction. It happens over and over and over again. All right. So what do we want to do? I'm just buying some February SPY puts, 260. I'm getting them for between $4 and $5 from when I started to where they are now. I think they're 450 right now. I'm only making it 2 to 4% of a position. Why? Because if this drops down to 230, I'll call it $5. These $5 puts will become worth $30. Right? 260 down to 230, you end up being worth $30. So your $5 turns into $30. If it's 2% of your portfolio, multiply by 6. Now it's 12%. And now you've created a bunch of cash to go and buy into the market. So you don't need a giant position here. You're not looking to speculate. You're looking to insure. And a 2 to 4% position is pretty good insurance for this type of a drop. So you don't need to get wacky and buy a ton of it. People cross the bridge from hedging to speculation, and you need to avoid that. And if President Trump and the Chinese agree to keep working on things, then you take your haircut on this next week. You lose half. That's life. And the rest of your portfolio goes up. So before you lose the other half, you cash in the time value. So here's the next thing. Oil. Well, actually, let's not talk about oil yet. I'm going to talk just a little bit about QQQ and an alternative to QQQ that I think is interesting. There's another fund out there, the iShares Edge Momentum ETF, and it largely overlaps QQQ. You see that their performance for the last 5 years has been similar, but the QQQ is a little bit better. So you take a look here. Those are the QQQ holdings. These are the MTUM holdings. Pretty similar up on top, right? But then you throw in some of the Dow Jones and New York Stock Exchange stocks, some of the better ones. Back to this chart. And in the last year, QQQ leads. But look at that 3-year chart. Almost identical, right? And then again, close. And there is no 10-year chart because momentum wasn't back there. So basically in the last year, momentum has started trailing at a greater rate than it has in the past. So you'd expect some reversion to mean. So I think if you haven't already loaded up on QQQ, or you have a reason why you can't, I think that this momentum fund is a reasonable one to own. And I don't know how it works on wash rules, but I would bet that you can get away using this one because the holdings are significantly different and the methodology is different. So we had been talking about wash rules this week, wash sale rules. And, you're taking your own chances with this. But if you need to swap out a QQQ for a tax break, and you want something similar that you think you can sneak in there, I think that this would probably be the way to do it. Again, consult a tax accountant. But I just would throw this out there because I do think there's some reversion of the mean coming. And I think you might be able to have your cake and eat it too there if we get a rally, right? If they if Xi and President Trump come up with an agreement not to level more tariffs and not to do other things. I'm not so sure that either side wants an agreement, right? I think maybe Xi is ready to go full scale with Saudi Arabia and Iran. Because at this point, Saudi Arabia can cut their own deals. And honestly, China buys a lot more oil from them than we do. So for them to take 15-20% of payment in yuan or special drawing rights, I think there could be something to that. And the Saudi Arabians, for their part, they want higher oil prices. Damaging the dollar would do that for them. So, we don't know what their currency holdings are and what their bond holdings are. So I just think that it's important for folks to understand that if the Chinese, the Saudis own bonds, and all of a sudden they damage the dollar, cause a recession here, right? Then interest rates come down. That makes their bonds more valuable. Now, there's an argument for stagflation as well. I just think that there's going to be so much money printing that will avoid stagflation. And I know that sounds counterintuitive. People say, well, printing money causes inflation. Well, not having the credit conditions to allow for capital development also causes inflation because it comes from the bottom up. If we can't afford to drill our oil and get our metals and minerals and our farmers to farm, that causes bottom-up inflation, right? Versus top-down inflation, which is demand-driven. We're not going to see demand-driven inflation in our lifetime again. It's just not going to happen. We got 30 years of these demographically driven deflationary trends to deal with. 30 years at least, maybe 40 or 50. So we really need to focus on, are commodities going to remain cheap? And the likelihood is not, but we have to keep them from causing a slow growth plus inflationary environment, right? In the scope of offsetting deflationary natural forces. There's a balance here. And Saudi Arabia and China may have different interests in the United States at this point, and that could cause a significant issue. The reason I don't ever get too bearish on the United States is because, honestly, if we just printed $15 trillion and stuck it into Social Security and pensions, that would solve a lot of problems, right? Create the lockbox for Social Security, start investing that money partially in the stock market, partially in U.S. Treasuries, and then put the, bail out the pensions, which is going to cost about $6 trillion. Now all of a sudden you have money that's been created, 15 trillion. You'd think, well, that's going to cut the value of the dollar in half, but it really wouldn't, because the deflationary forces over the next 30 years, that money is actually trickled into the economy through the pension payments and through the Social Security payments, right? It doesn't hit the economy all at once. It trickles in over 30 years. Those forces would relatively offset. So I think helicopter money is inevitable to bail out the boomer retirement, and that could coincide with the Chinese and the Saudi Arabians saying, hey, we don't really need the petrodollar anymore, or at least we don't need it to be quite as strong. We need oil to go up. And the Saudi Arabians need oil to go up. The Chinese need it to stay cheap. You buy it in yuan. That's how you do that. And I hope somebody is telling President Trump, hey, they have other cards to play. It's not just about trade. They want a consumer-driven economy. At some point, they need their currency to go up in value. Trump could be forcing that issue. And if he thinks that a weaker dollar is going to help the United States with trade, he's wrong. Because as I talked about in this article here, supply chains are going to where the customers are, right? You don't need tariffs to move a supply chain anymore. Why? Because automation of anything low end means that you can build a plant next to the customers and just ship it to them short distance rather than over the ocean in a freighter. We have seen freighter traffic drop. So we shouldn't expect that really to pick up. So I know there's people who want to invest in freighter companies. And I tell them, I don't think we're going to see a great big pickup in global trade ever again. All we're really doing is fighting to see it not drop as fast. And right now, what President Trump and President Xi are at the brink of is causing global trade to drop fast. And that would have a short-term impact on GDP that lasted a year or two. That would be very painful for the stock market. So that's why the SPY puts, just in case. I think we're going to have these problems eventually anyway. It would be nice to have them smoothed out and blended into an infrastructure plan and water plan and grid plan and alternative energy plan and fix the healthcare system. You don't want these things individual. You need the things that you know are negative to be offset by things that you are hoping will be positive. And if we get hit with a big negative event right now, we don't have anything in place to offset it. So the SPY puts. I'm at the 260s. You could go a little bit in either direction if you wanted to. If you think you find a better price. All right. Cleaning up an oil spill. I have, in no uncertain terms, got my ass handed to me on this last oil trade. Here, my ass handed to me. And it's kind of funny because in the last week I've had my first man issues as I grow older. Had way too much stuffing on Sunday night, and that has caused a little bit of a tummy ache for a few days. But I think there's a way to fix this oil trade. And I want you to think about what is really going on in oil. And this is going to be a whole article that I put out on Monday, but I just whipped it up this morning. The Saudi Arabians want oil to get up to what, $70, $80? Gerald, wake up! And the Russians are wiffle-waffling back and forth on that. One guy says, hey, its price is fine, and it'll do what it does. Another Russian says, oh, yeah, we'll cooperate. And really, the Russians have just been trying to free ride this all along. They haven't been the best partners in ROPEC, but they help a little bit. So the Russians, for their part, in the oil supply reductions that are coming, Russia is just going to let their production drop gradually by not putting as much money into it, right? So they're not going to cap a well. They're not going to, stop shipping. But as their wells decline and some of them deplete, they're just not going to replace them as fast. Saudi Arabia, on the other hand, is on the hook. So Saudi Arabia is going to do two things. They're going to cut their oil exports by 500,000 barrels a day. And I'm going to 500,000 barrels per day per month. Ooh, that's a typo right there. And that's a big deal. So if we take a look at U.S. imports of petroleum from Saudi Arabia, they've been down near zero a couple times, right? Over 2 million barrels a day. And then recently they were all the way down to a little over 500,000 barrels a day, and then they doubled it quickly ahead of Iran sanctions. You can see the line. This is the line of raising imports from Saudi Arabia ahead of the Iran sanctions. You want to be aware of where Saudi Arabian oil goes in America. Most of it goes to the Port Arthur refinery that Saudi Arabia owns. That refinery can do about 600,000 barrels per day. All the other oil they sell to other people or they store. So if Saudi Arabia is storing as part of the inventory, which is now 450 million barrels, and they want to see our inventory fall, all they have to do is ship less oil to their own refinery. The Port Arthur refinery is the biggest refinery in North America, and the Saudi Arabians own it. They did that for a reason. That gives them more power as a swing producer. So when they cut imports to the United States, when oil was cheap, oil got more expensive. They raised imports to the United States, oil got cheaper, and now they're going to drop these exports all the way down, probably to 500,000 barrels a day, maybe 600,000. But if you go to the EIA website, you can see down here how low they've gone recently, right? Price of oil went up as they cut exports or imports to the United States. Exports from Saudi Arabia, imports to the United States. And then Trump announces Iran sanctions, and bam, more oil. And then this number is going to come in at about 1.1 million. December is going to come in at about 600 million. So it's going to fall off a cliff from 1.1, 1.2 million in here. I think we've had these announcements. They're just not updated to the chart. Then the December number is going to be about 600,000. Then next year, you'll see a bunch of numbers around 600,000, and they might even dip it all the way down to like 500 or 400,000 in the months of January and February because they have lower production then anyway. And then they have some maintenance. So you're going to see some pretty low numbers. So that's how they're going to reduce the record, or not, it's not even a record, it's just the highest inventory in like 6 years or something. Inventory went up to 450 million barrels. And I believe you're going to see them shave about 50 million barrels off of our inventory. I don't know how much they store at Point Arthur, but if they're running at 600,000 barrels a day and they have, several million barrels there, they're going to run that inventory down. So that means that they may, for several months, import well under 600,000 barrels a day. So keep that in mind. So not only is that barrels not going to the other refiners, but it's them using up their Port Arthur inventory. So I would expect, and here's the equation, 450 million barrels of U.S. inventory right now. They cut imports us by 15 million barrels per month, right? That means that by April, we're down to 400 million barrels of inventory in the United States. And now we're below the average again, the 5-year average again. And what if they never send us more than 500 or 600 million barrels again? What if they only supply the Port Arthur facility? And that's the only oil that they send here. That oil, by the way, gets used at these Shell gas stations in the southeast part of the country. So if you don't like Saudi Arabia, don't buy your gasoline at a Shell station for the southeast part of the country. If you don't like Venezuela, don't buy gasoline from Citgo because that's still where most of that comes from. Although that's been changing. So what's the trade? We have learned, and for me, relearned a lesson in using levered commodity-driven ETFs. And in the future, I'm going to be a lot more firm on this. If you're not a day trader, you should not be using levered ETFs, because if they don't move in your direction pretty much every day in a straight line, you're screwed. Because when these ETFs go down triple in one day, that means that they have to go up more than what they went down in dollar terms to get the money back. And that's a problem. It's an algebraic equation problem, right? Think about if you have $100 and lose 20%, you're down to $80. How much of a percentage do you have to make to get that 20% back that you lost? Anybody in the gallery? Pretty easy. 25%, right? Because now you don't have to make 20% of the 80 that you have left to get to 100, because that would only get you to 96. You need 25% of the 80 to get you back up to 100. Well, that's the equation that you're using with leveraged ETFs, but in double or triplicate. And that's a problem. So I'm looking for a way to get out of USOU. I'm fairly certain we'll get back to even because I think these oil prices are bottoming right now, but I've been saying that for 3 weeks. I am shocked at how strong the traders are, but I did explain that today as well. So I want to buy the oil stocks today, and I have been buying some options. I've been focusing on the Encana $10 options for 2020. I'm pretty much I would imagine I'm almost all of that volume. See if I can show you that option chain over at TD Ameritrade. Volume over 1,000. I'm not 1,000, but I'm over half of that. And the open interest, I'm probably over half. I'm over half of the open interest too. So not this one, but I've been buying this one today. So I like that one a lot. We can look at yeah. I just started buying these. Pioneer. What price level is this? None of my orders have executed. Interesting. Okay, but I have some orders in here. None of them have executed, so I might have to raise my price a little bit. Okay. Then I've bought some Centennial today. Why these 3 stocks? They're all Permian driven, right? And Kana got the crap kicked out of it on that merger with Newfield. Was it Newfield? Yeah, Newfield, right? It was a good merger. I'm not sure why people are poo-pooing it. Again, I think it's just because the traders have power. And I explained that here. So, and I'll show you the charts in a second. The reason why this correction has been so volatile is because the traders have been able to price in virtually all of the expected pain if the Fed would have kept tightening and stayed bearish, stayed hawkish, and a China trade war, right? Now, here's the thing. China trade war is going to knock 1 or 2 points off of GDP. That's painful. It doesn't kill us. It's the retaliation from the Chinese if they hurt the dollar. That could get hurtful. And I think it's coming. I just don't know when and how. But in any case, the stock market is weak right now because the marginal buyers in the stock market in the last several years have been who? It's been the money from the banks through QE that's been drying up now, and it's been the Chinese. Chinese investment in the United States fell off a cliff. And that's why back in July, I said, hey, it's time to start being a net stock seller. That's why we carry high cash balances. The off-market buyer, right, the marginal buyer, is gone right now. And it's because of the central bank tightening, because of the Fed tightening, and because China investments in the United States fell off a cliff. 2018, they're basically zero. We need Chinese money. We don't really need this, but we need numbers like this. If we don't get numbers like this of Chinese investment in the United States, that's a problem. That's a hole to fill. So where do you come up with that money? You know, where do you come up with 30, 40, 50 billion more dollars a year for the stock market? Just throwing it out there, right? So we have to keep an eye on that. More than that. In any case. Why the Permian stocks? Because right now, Permian oil is getting about $8, $7, $8 less than WTI, right? That gap is going to close as the pipelines come on, and the forward hedging prices are going to go up as the price of oil stabilizes, probably in the 70s for WTI, probably in the 80s for Brent, because that's what Saudi Arabia wants. What Saudi Arabia wants, they will get. And we are going to have to figure out a way to make money on a more stable price in oil. That's what I've said all along. It'll be range bound. I think we've inexplicably had a correction, not inexplicably, but just surprisingly to me, had a correction that was greater than what the range indicated. An oil price under 60 doesn't make any sense because nobody's making money. Nobody's making money. So the price of oil is going to go up. Saudi Arabia is going to change how they do the imports, and we don't have the capability until next summer to increase our production. So for next 4, 5, 6, 7 months, U.S. production will be relatively flat. It might tick up a little bit on a couple extra barrels out of the Permian, not the Permian, the Eagle Ford or the Bakken or Niobrara or something. But Colorado, I think, is still going to fight oil expansion, even though that Prop 112 didn't go through. So, because the Democrats did win the governorship, and I believe they have a majority in their legislature. So, you just don't have a lot of places where oil is going to come from in the United States other than the Permian. And we've showed charts to that effect. 3/4 of the new oil in the United States is from the Permian. And if there's no new pipes until the second half of next year, no new oil because all the pipes are full right now, right? So once those pipes come on in the second half of next year, this spread is going to shrink very quickly. And in fact, I think Permian oil a year from now might trade at a premium to WTI oil. Why? Proximity to the refiners, and because I think they're going to overdo it on the pipelines. At least that's what it looks like. They're going to have more pipelines than they can use, so that's going to be very favorable for the drillers. And the three, like I said, the three that I like: Encana, Pioneer, and then Centennial for capital appreciation. Now, if you want to own one of them for dividends, Occidental all day long blows away Exxon. So I wouldn't be owning Exxon when I can own Occidental. I subscribe to ETF database, and I will get a abridged version of this to you. But they're talking about how the energy ETFs could be a huge value right now. And, they talk about some of the things I talk about. And again, they think this is an unjustified drop too. This is an overreaction from traders who had some power because there's nobody to fight back. That's it. Nobody to fight back. Now the Saudi Arabians are going to fight back. And the Saudi Arabians have more money than traders, so they're going to win. So you're going to see this boom, 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 all the way back up. Energy sector relative value, right? Energy led, energy didn't lead. Led, didn't lead, right? So it's just natural to come back up. I would expect energy stocks to lead the market only because I think a lot of these old grandpa stocks are going to be really bad. So between technology and energy, I think that's where you need to be for the next couple of years. And then if we see a real recession developing, again, then we're going to have to go to 75% out of the market. And that would be the big defensive position. We'd take 75% of our money out of the market. You only leave 25% in your best ideas. So which fund are they talking about? Look at that. XOP. Gundluck. Everybody's talking about XOP. The Vanguard Energy ETF is pretty good too, although it's more Chevron and Exxon that I would want. So you take a look at Pioneer. Money flow's actually been pretty good, not great. It turns up here. You should see a rebound. Centennial, pretty good. Keeps going up. Should see a rebound. And Kana, big jump because of the merger. Little fall off because people are like, oh my God, it's a merger. They're bad idea. It's not. That merger was a great idea. When they sell their Bakken assets, and they're on sale. When Encana sells their Bakken assets, they're going to drop a lot of money to the bottom line. Same way that I told you that Nutrien was going to drop a lot of money to their bottom line. What's happening to Nutrien in a couple of days? Anybody know? What's happening to Nutrien in a couple of days? How much money is dropping to their bottom line? You're not watching your investments? Tisk, tisk, tisk. All right. Nutrien is another reason you need to buy Nutrien if you don't have it. Closing the deal on selling their share in SQM. $4 billion. Going to drop to their bottom line. They're going to put it towards debt reduction, dividends, buybacks, and then Agrium has that retail network, and they're going to beef up that retail network. So, every farmer in the world is going to be buying from Nutrien. And why? Because potash, the reason why we're strategically in potash, not something like CF, right? Why we're not focusing on phosphates and nitrogen in fertilizer, the reason we're focusing on potash, what does potash do? Potash can replenish your soil when it's been too dry, when it gets burnt out. And that's what's happening, right? We're losing 3 to 5% of arable land every year. In the Midwest, if you just took a look at the climate report that came out, who cares why it's happening? It's happening. The Midwest is losing arable land. That's a lot of food, folks. They have to figure out a way to not lose that arable land. It's going to be potash sales. So I expect Nutrien to break out at the top of this range. I really do. Next couple of years. This could be something that goes up when the stock market goes down. I was taking a look at XES, the oil and gas equipment and services sector ETF, trying to find anything in here that I really liked. I don't know what ProPetro Holding is. I know what they are. Helmerich and Payne. Been in that name before. That cash flow into the stock. Stabilizing. Looks like it's about to run. If you're looking for a dividend stock in oil services, I strongly suggest Helmerich and Payne at these levels. It looks like they're about to bust upward. And you collect a 4.7% dividend. Now, I don't know that it'll ever break 100 again. So I think there's a stock that at 80, 90 bucks a share you have to get rid of. Here 78, 83. Yeah, maybe 80-ish. Probably get rid of it. Or at least sell covered calls. If you're looking for income, sell covered calls around 80. Baker Hughes. Interesting. Somebody's thinking about Baker Hughes. Somebody's investing in Baker Hughes. And look at that. They started investing here. Where the money starts going in. Then look to the right up at the price. Money starts going in. Look at the bottom. Money flow starts going in. Price stabilizes. Starts to turn up. I think that this is probably actually a pretty good buy. I think it probably rallies up for sure up to this moving average. I think it probably goes through the 50-day. I think it probably rushes the 200-day. Hey, maybe 30% trade here. And do they have a dividend? Oh, look, and they have a dividend. So, Helmerich and Payne, Baker Hughes, those would be two that I would look at as, okay, if oil services does rebound next year because of all the extra pipelines, I think these are the two players to go with. They have good balance sheets, pretty good price to book, right? Pretty good price to book. All the ratios look good. They spit out a dividend. They're undervalued. There's cash flow going into them. US Silica. I have gotten burnt on sand stocks before, but I pay attention to them because there's one of them in Wisconsin. High Crush, I think, is in Wisconsin. Look at this. You have that blow off bottom, and then money starts going into the stock. Stock hasn't really turned up yet. It's about to hit the 50-day moving average. I think it blows through, makes a run at the 200-day moving average. These guys don't pay a dividend, I don't think. Oh, they do. A little dividend there. Their debt to equity isn't as good because they need a lot of capital to keep on producing. Price to book is real good, though. But I think this is a heck of a swing trade, too. Why am I talking about swing trades? Maybe I'm about to open a swing trading service. And this is the sort of thing that you would get. Okay. I think these are all three of these stocks can be owned. The more conservative you are, the more to the left you move, right? The first one. This is the one that you buy if you're more focused on dividends. This is the one you buy if you're looking for a big swing trade. And Baker Hughes, I just think that it's bottomed out. Decent dividend. And I think you can see a ride. Yeah, that's a good one too. All three of these stocks are good for swing trades, and I think if there's a big need and demand for oil services, HP and Baker Hughes are the two to own. I know that people want to talk about these jerk faces. I don't like the way that Halliburton is run. They don't have a good price to book. They have more debt. They have less growth. But money's been going into this part of the sector too. So they probably get a rally as well. I just don't think it's as good of a company. So I'd rather go with the better companies, which are HP and Baker Hughes. Right, fair enough. Baker Hughes and Halliburton were going to merge, right? And then that deal broke up. Halliburton's still paying penalties for that. They still have other debts. Take the better company. Take the lower debt, higher growth, better positioned companies. Just because Halliburton's the biggest land driller, at least according to them, I think it's HP. Depends on which numbers you look at. There's that. Schlumberger, they're probably also getting capital inflows. Yeah, it didn't turn up quite as much. So, something sold. Man, new account, cleaning it up. So again, this is probably going to rebound as well. Now, if you wanted to own XES right here, and not try to pick the companies, we sold XES a couple months ago. Good, right? Good. Sold for around 16. If you just wanted to, oops, wrong one. If you have room in your asset allocation, these guys are getting inflows. It's probably going to turn around here soon. So next week, if there's a blow-off because of trade, I think you can look at these service companies as a group or just pick some of the best ones. I also think that if there's no trade agreement, you get a blow-off on these, and you're going to be able to buy a lot of stuff super cheap once that market drops another 10%. So we'll play it by ear, and next week we'll know if we are in bad trade land or good or okay trade land. Yeah, we might get the good trade land next year. And one of the things that gives me hope is that Trump did just sign the deal with Canada and Mexico. Seemed sort of happy about it. He looked weird at the signing, but they made the deal. And it was tweaks. So if he goes to China and accepts tweaks and marginal improvements versus wholesale changes, right? He talked to Mexico and Canada about wholesale changes, and then the deal they took was tweaks and marginal improvements. If he does the same thing with China, takes tweaks and marginal improvements, setting up for more tweaks and marginal improvements in the future, then I think that we are on a good path. If he stays with they got to make wholesale changes, it ain't going to happen, and China's going to retaliate, and that retaliation is probably pretty bad for us. So we'll keep an eye on it. I'm going to glance at the questions real quick here. But like I talked about in the chat room, you need to submit your questions ahead of time from here on out just so I can get these calls done in an hour. Covered that. Already talked about leveraged ETFs and inverse ETFs. I'd rather use options. I think if you're not day trading leveraged ETFs and inverse ETFs, that the math works against you. So you have to day trade those. That's just all there is to it. So I'm pretty much telling people, stay away, learn how to use options, period. Learn how to use options. Stay away from the shortcut leveraged ETFs and inverse ETFs because there's a price for those. And the price is high. And if you don't handle them wrong, the math works against you, and it can never, ever come back. You lose time value with an option contract, but that's nothing compared to the algebra that's working against you with these leveraged ETFs. Do you think Encana has bottomed out? I've thought that a couple times. But yeah, I'm buying Encana. Talked about Schlumberger. Yeah, I think it's kind of funny that I said that not only should he not go, but to have his phone turned off. But then he shows up getting off of Air Force One. I think he snuck on in the baggage department. VCell, I don't know. Stop asking me about stocks that aren't on our list. All right, there you go. Fundamental Trends as a forum, not a chat. All right, we are good. We are exactly. I think we're under 1 hour. All right, I'm gonna hurry up and end this because I want to stay under an hour. I want to say 59 minutes. All right, everybody have a great weekend. Do something nice. Watch the Sunday morning news shows because they'll probably be exciting.